Hello and welcome to the Trading Zone. I am Joe Teague, portfolio manager, Rational Equity Armor Investments. That's Rational Equity Armor is a fund. Equity Armor Investments is, of course, the company. Thank you all for joining me today. I was on a little bit early, gave you a quick preview about volatility. I'll give you another really quick recap on volatility, and we'll get into what's going on in the week. Just me today. Brian's recovering from the Detroit Lions beat down the Chicago Bears yesterday. As my Detroit Lions hung up a 50 burger up against the Chicago Bears and Ben Johnson. So he's not doing so good, but the stock market is doing just fine. So let's jump right into it. We got stocks higher on the day. Volatility, of course, lower. Here is the VIX on the year. It's not doing a lot, as we can see lately. It's been a minute since we've had one of these arrows signaling a new wave of volatility. We are overdue for one. There's no question about it. There's no guarantee that's going to happen anytime soon, but we do have a big event coming this week. I'm going to get into it in a second. JP Morgan, Morgan Stanley, absolutely predicting volatility to return in the market to correct after the Fed moves on rates this week. We do have bond market volatility, something we've been watching very closely, of course, making another low here. It's just been trending lower and lower and lower. We've talked about it on this program for a while. This is liquidity to the stock market. That's, of course, great for stocks. Liquidity to the market also is just a boost to PE ratios. You can track this against the forward PEs of the stock market. The lower the bond market volatility, the higher the forward the PE of the S&P 500 is. So, of course, if this stays low, you're going to see stocks do fantastic. Let's take a quick look at the SKU index. We like looking at this. Obviously, this is a leading indicator for us for volatility. It measures the volatility of the 25 delta put 1 month out in the S&P 500 compared to the volatility of the 25 delta call 1 month out in the S&P 500. We are seeing very cheap puts right now. We're still getting higher lows here in this trend, but we're seeing very cheap puts right now. It's on the floor from where you would expect it to be. We're really expecting a bounce from here. That doesn't necessarily mean it has to happen. It's just something that the past few times we've been down here, it has happened. So be watching that, of course, very closely. Again, all eyes are on the Fed this week. We know they're going to cut. It's just going to be the language that they come out with and what that really determines. Real quickly, here is the futures curve. Very flat on the front versus the spot. We know that the spot is actually expiring Wednesday morning before the Fed announcement, so no surprise there. But I will say it is surprising how steep we are from the spot to where the second month is, which is essentially the front month right now. It's just a day and a half, and the big event's not really going to be encapsulated in that. So the October future above, we're right below 18 right now, very high compared to where the spot is. So it's a big gap there. We'll be watching that closely. Is that something that's the future is going to come down to meet the spot after the Fed event? Or is the spot going to come up to where the future is after the Fed event? One of the two is very likely to happen. We'll be watching it. I'm sure you will be too, keeping your eyes out to see what happens there. But here's what some strategists are saying here. They're saying, yes, we know the Fed's going to cut. The market has priced this in for some time. The Fed is going to cut. We saw this last year. When the Fed started to cut, we saw some turbulence in the stock market. But essentially, they're saying, okay, now we know the Fed's going to cut. What's the focus of the market going to be now? Up into this cut, it's been really focusing on inflation and saying, hey, the Fed's going to cut as soon as inflation's kind of in check. If inflation can come down closer, we're not at the Fed's target. We're a lot closer to where the Fed's target is. If inflation can be close to the 2% goal for the Fed's target, then the Fed can cut and say, hey, this is great. Well, we had inflation data last week. It wasn't really great. I mean, it was good. It wasn't fantastic. We did get a slight tick up, and maybe a little bit worrying sign for some people that are closely following inflation. But maybe after this cut, the market's going to say, hey, wait a second. If inflation's not really where it should be, then why are we cutting? And the answer might be, oh, wait, this economy is slowing down. This jobs data is looking really weak. So if we're asking those questions and the narrative switching from is inflation coming down to, is the economy slowing down, I think they're going to see a little bit harder path for stocks. Of course, lower interest rates are great for growth stocks. Lower interest rates are good for stocks, but a slowing economy is worse. I think given the two choices, a strong economy and high interest rates, or a weak economy and low interest rates, the stock market's going to choose a strong economy and high interest rates 10 times out of 10. So we got to be careful what we wish for. If the market's expecting the stock market to go higher because rates are being cut, we might be in for a bad a bad outcome if the rates are being cut because of a slowing economy. And right now it seems like that is the case. We'll be watching it very closely, of course. Maybe things can adjust quickly. We get a sharp adjustment in these rates. The economy can kind of stabilize itself, and then we'll go back to that inflation. If we have a stable economy, we'll go back to that inflation check and say, hey, is this inflation going up, in which we cannot lower rates any further, or is this inflation going down, in which the rates can continue to go down? And of course, I'm not really so sure that the stock market won't be so upset if inflation is going higher, as long as the economy is on track. I think we're going to get into this in a little bit, but a stronger economy plus rising inflation will be fine for stocks. In fact, we wrote a post here on equityarmorinvestments.com at the Ripple Effect blog talking about the Fed could trigger a crack up boom. Now, this is an economic term from the Austrian School of Economics. When the assets or when the currencies around the world are being devalued to such an extreme extent, people will avoid cash, avoid anything currency based, and look for some hard assets. And stocks are included in those hard assets, as real estate, as commodities, and of course gold and silver, and maybe in a newer world cryptocurrencies, but more so for me for the hard assets like the precious metals and real estate and commodities, just like that. So I'll get into that in just a second. Real quickly, let's take a look at the indexes we've been following all year long, and of course are very keen to see how they're following. And we got options expiration coming up at the end of the week. These futures are going to be settling here for the S&P 500. We blew by that 6,500 spot like it was nothing, kind of exiting. We have escape velocity essentially from there, just continuing to crack up, melt up, however you want to say it. People are just expecting currencies to continue to be devalued. That's the same thing going on in the NASDAQ, just another absolute melt up session going on. This is happening in the middle of, a technological boom too, but we're just absolutely seeing a fantastic rally higher. No reason to think it's going to be stopping anytime soon. Semiconductors, for me, the leading indicator for all these indexes, reaching all-time highs, another great sign here. And finally, let's take a look at the Mag 7 index. Boom, just absolute crushing it, breaking out. Oracle's not even in this Mag 7 index, of course. Oracle, huge winner last week. How would you play Oracle? Well, stick around to the end of the show because I actually have a trade example on Oracle, or me trading Oracle at the end of the show, how I am playing it after that big winner we saw last week. But this is just a sign that, hey, this mega cap tech is absolutely crushing it in this environment, and people are running for these companies. We did a trade on Google last week. Great winner so far. We're going to continue to let that run. I'll show you that at the end of the show too. But bottom line is, it's not only the U.S. In fact, the U.S. is almost even late to the party. Currencies around the world are being devalued. There's a ton of liquidity in the market. Everybody wants to be lowering interest rates. And this is happening in spite of inflation, but it's just absolutely just a complete party. Everybody wants to pour liquidity, print money, add to the ecosystem, just more and more and more. And yes, so we've just seen a massive rise in gold. This is not a big surprise, but you think about this huge rally in the stock market. But for me, it's just like there's just a rally in every single market. If you look at real estate, it is going higher and higher. If you look at rent prices, it's higher. If you look at tuitions, it's higher. Insurance premium, cars, everything is just costing more and more. Just a share of stock maybe is no different than going to the grocery store and getting anything else. So just everything that we're using dollars for is costing more. Now, if you take a look at just a couple year chart here for the dollar, you'll look in here and you'll say, wow, this is being devalued very, very quickly. And it absolutely is, especially in 2025. We're just seeing a complete crush of the dollar. People are expecting more dollars to be added to the system and the dollar to be devalued. If you take a step back, though, maybe look at like 15 years, the dollar's been up and down. It's been kind of all around. But there's a lot of other currencies that go into play here. This is just a dollar measured against other currencies. And the fact is, all the currencies the dollar is being measured against, they're all doing it. They're all pouring money into the system. So it's just a sign that, hey, inflation is just a part of life. It is happening, and it's not slowing down anytime soon. And anytime you get into these cycles where the Fed's going to be cutting rates, you kind of should expect that to accelerate again. Now, here's just if you look at pricedingold.com, the price of a dollar versus gold, and it's just shocking. Just in the past 25 years, 27 years here, how much our purchasing power has gone away, and just really a sign that things are just going to be continuing now. But if you're thinking, okay, so if gold is the real value out there, yeah, I need more dollars to buy gold, but the price of gold hasn't really changed as much. It just costs more dollars here. People are still you could have owned gold then and own the S&P 500 in then. So for me, if I were going to say this stock market is a bubble, I would have to say, okay, in terms of the price of gold, the stock market looks really high. And you can actually look at that. I chose to look at the NASDAQ. You could look at the S&P 500 if you like to. It's very similar. But you went back in time and you say, okay, this was what the bubble looked like. And you saw this in the dot-com bubble, where there was just a rapid rise in the price of the stock market compared to the price of gold. And we're kind of in the middle zone here. Now, this obviously is higher than it's been in other times right now. The stock market's more expensive in terms of gold, or at least in terms of the NASDAQ, it's more expensive in terms of gold than it has been historically. But we're nowhere near the bubble peak we saw in the dot-com boom. So it's just something to keep in mind. Could this be the top? Yes, it could be the top. Could there be a lot more room to the upside? Yes, there could be a lot more room to the upside. Just taking everything with a grain of salt. We just have to keep things in the big picture, because nobody really knows what what's going to be coming next week. But anyways, let me just one more time break it down on this crack up boom theory. This Austrian economic theory is where, this could be like a catastrophic event. It doesn't have to be, of course. It could just be like another wave of inflation, a double dip inflation, a triple dip inflation like we saw in the 70s. Just something we need to be very careful of. So it would be, where people would say, hey, these dollars, these currencies this fiat is being devalued too much. We're going to dump cash in, much rather have hard assets. So we're just getting out of cash and into hard assets. And this is just, just think about it. Like, if there's more and more cash in the system, and then things just gradually become scarcer and scarcer. I have 3 children. Anytime there's just 2 toys that they all want to be playing with, I can see like the scarcity of resources and like the economics at work. Just imagine a system where like you're playing musical chairs, where gradually chairs get pulled away, and the chairs are more aggressively fought after as there are fewer and fewer chairs. You just have to think of that system that like a crack up boom as we're starting. It's just kind of builds on itself people are looking around saying, hey, I need these hard assets. At the start, there's plenty. At the end, there's not so many. And that price is going to be the highest at the very end. So we'll just watch that, see if it does play out that way. Hopefully it does not, obviously, but we'll be watching it very carefully. So I mentioned at the start of the show, we did a trade last week. It was in Google. And yeah, this was just another fantastic winner. It's kind of an example of how do I trade a stock that had a huge ramp up and then kind of paused. What do? Do you want to buy this gap higher? Do you wait? And my solution last week for Google was to kind of have like a cash secured put with an upside call spread. This allowed me into Google with very low cost. In fact, I even collected 20 cents. So I sold the December 2025 19 put, bought the 240, 260 call spread in December, where I was buying the 240, selling the 260 call. And that allowed me to get into Google by collecting money. So yeah, I obviously would have had to buy Google down at 220. I owned it at 240, get stopped at 260. Love that trade. We're back. We're up to 248, 249 right now in Google. Fantastic winner. It's now worth 470. Great trade. Really happy about that. I'm leaving that on, obviously. Going to let that play out for another few weeks at least and kind of test it out. But as I mentioned, Oracle, just tremendous earnings. A lot of skeptics out there are saying, hey, a lot of the forward projections are not necessarily guarantees. They're just kind of handshake deals. So yeah, there's maybe a little bit concerned out there. But if it turns out if those deals turn out to be true, this company is still undervalued. So yeah, I mean, for me, Oracle fits in very nicely into this narrative of companies that will do well in a crack up boom. Of course, the AI just has fantastic pricing power. It's just something that is scarce. It's something that people are fighting to get into. And absolutely, I think they are a huge winner in the cloud world, just like Google is, of course. A massive contract backlog, of course, we talked about that just a second ago, and they are strategically positioned to take advantage of all of that. So with all that said, I am just looking at in October, this is just simply selling a put spread in the Google name. I bought an upside call spread because I was thinking there's more upside potential. We just had a 30% gap higher in Oracle. I'm just looking for a little bit of consolidation. And of course, this is a shorter time period here for Oracle. I'm just looking 1 month out. I'm going to look at the 280, 260 put spread, collect 470 for that. So I'm going to sell the 280, buy the 260. Max loss, of course, would be at $20, but I have a $470 built-in premium collection. So, max loss is a little bit more than $15 here. But I'm able to get into Oracle here at $280 right now. It's a little bit over $300. So this is certainly an area where, as of today's prices, I'd love to own it, considering it's almost 10% lower there than where it is currently trading. And I'm going to be able to collect, 1.5%, 3%, 1.5%, 2% here, just holding and waiting here while we're hoping for some consolidation. I'm not looking for this name to break out and reach all-time highs before October. I think a great scenario for Oracle will be a consolidation pattern where we can be sideways for a month before returning higher. So this is a way for me to play a name I love to the upside, profit off of the higher than normal volatility on it, and not get my face ripped off if I were to buy it at 300 and see it collapse down to 280 within the month. So just something I like to look at when I see these big gap higher. How can I play it? Google was a similar story, but we saw a 6% gap higher and then continue to run. Oracle, just huge 30% rally. I think that's a different story. Obviously, volatility is really high in this name when you get a gap like that. So that's why I'm looking at Oracle in that way, and just looking to play it for some consolidation. Love to buy it on a pullback. Otherwise, I get to collect my premiums and move forward. Thank you very much again for joining in Every Monday, we're here at noon Eastern. I give a quick volatility update in the morning if you like to join in on that. If you want to see these trades before the show, make sure to check out the trade alerts. They are out there. They are for you. I hope you all enjoy them. Again, I'm Joe Teague of Equity Armor Investments. I hope you have a great week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.